Ugh, I mean, come on. The market's only had one job, and at this point, you can't do much more than just laugh. We literally find ourselves smack in the midpoint of the April month and a half long balance range that drove traders absolutely mad, is putting it lightly, before finally starting to break in the upward direction here. So, frustrating, yes, but do we have to trade the chart in front of us? Yes. So, we can't really afford to project our frustrations onto this market. Otherwise, we risk paying for that, not only with our P&L, but irrational decisions lead to bad habits, right? So let's take an objective look at all of the relevant data points to build a plan for the remainder of this week. Before we go into any of the analysis, it is worth pointing out that NVIDIA is gapping up on earnings about 70 points right now. That is a massive complicating factor, considering that we're still dealing with bearish divergences across the board, and we did see some breakdowns on the Tuesday and today's Wednesday session. So we'll of course take that into consideration, but I think the best bet is to use a day-by-day approach into the remainder of this trading week. We have PCE on Friday. It's the Friday before a long weekend. People are possibly taking off early. I don't think it's worth getting overly committed to this market as we find ourselves comically back in the midpoint of the oh so annoying balance range. Let's get started here on the daily time frame chart. If you would, do me a favor, hit the thumbs up button, subscribe, all that good stuff after the video, not now, after. Check out the links listed down below in the description. Stay tuned until the end. I've got 3 additional trade ideas to share with you. SPY daily chart. What's going on here? Daily trend was up with the higher high after a sequence of higher lows, and we know that we were looking for a higher low on the daily time frame chart. In a picture perfect world, it was going to be here at 417.25, did not happen, and the line in the sand was here at 413. On today's session, we gap underneath that level and spend the entirety of the trading range underneath. So that has certainly produced an equal low on the daily time frame chart. Thus, the daily trend at best can be classified as neutral. There is no edge here, bull or bear, from a trend perspective. If we think about this as a balance range, yes, this pattern here, look above and fail, is bearish. And in theory, we should be targeting the bottom end of the range at 406.15. But there are 3 very specific reasons as to why I don't think that's in play for the remainder of this week. The first reason is that we're technically extended through the lower edge of the weekly expected move. It's just a suggestion from the options market, but it's not the only reason. Reason number 2 is that we've seen a full-blown 100% retracement of the breakout range here, and we're already starting to see support in this lower wick at the 410.35 equal low logical area of support. Just remember that when you see a 100% retracement, it's very rare that markets immediately start continuing through the equal low. As a very brief example, look at what we have right here. I'm not making the sort of assumption or trying to suggest that we're going to produce something that does this and make a move in the upward direction now. I'm just pointing out that it's hard for markets to continue through this, thus decreasing the odds of making it to 406.15 into the remainder of this week. Reason number 3 should speak for itself. It's NVIDIA earnings, right? In the post-market, we're already trading 413.02 by 03, so literally right on this level. If we gap green over red, it's a reason to believe that anybody who entered a new money short on today's session will be squeezed out, and we can see a move in the upward direction. So that's why I don't think we're going to 406.15. That's why I don't think that the look above and fail is going to pan out into Friday. Now, over time it could happen, but perhaps look for a lower high first. Now, because on the daily time frame chart, we're in the midpoint of this range, I don't think it's worth doing any more analysis on this time frame. Let's take it day by day and take a more nuanced approach on something like the hourly. So first and foremost, notice that we gapped down this morning, and a bearish indication is always a gap and go. In theory, there's zero structure overhead, so the buyers should do their job and they should close that gap. It didn't happen early on in the session, so that is a bearish indication. In the afternoon rally attempt, notice that we break over the morning high, new high of day here, and once again, there's a sharp rejection preventing us from closing that gap. So at first glance, the sellers absolutely have control on today's session. That goes without saying, and we'll also see that on the market internals. Now with the NVIDIA gap up from the earnings, if we find ourselves gapping green over red, over 413, there's an interesting opportunity for anybody who went out short here, rejecting and preventing this gap close, to squeeze out of their position, making a move in the upward direction. Now notice when we look left, this breakdown on Tuesday had extremely thin structure underneath 417.25. 417.25. Therefore, I think it's reasonable to look for a retracement towards 417.25, and then we'll look for a rejection off of this level in the downward direction. Remember, the daily trend is now neutral. It's not really fair to assume that this level must break, and we must look for trend continuation in the upward direction. This is fair game for a big daily lower high, and when and if that happens, that'll really start to cement more of the look above and fail scenario on the daily time frame chart, and over time, yes, we will look for 406.15. That's the upside. That's gapping up and over 413. If we open in here and produce a higher low over 413, the same idea applies. The shorts who totally were in control on today's session, right? They were in control. Credit where credit is due. They will get squeezed out if we get the higher low over 413, primarily driven by NVIDIA earnings. We have thin structure here. There's not a lot of resistance until we come into 417.25. That's the upside. Now, downside is complicated because, as we just pointed out, we're through the lower edge of the weekly expected move. If we just start chopping around in here, it's exactly that. I would not want to be overly biased one way or another in this godforsaken range, right? This is just not the place to be getting active. If we do see a breakdown of 410.35, this is a poor low in here, it would not only repair that level, but a lower high underneath is the only way to get involved on the short side, noting that you have decent risk reward, right? You could technically place a stop just above the level, and you're going to target the top of the gap here at 408.65. So that's your downside play, and the risk reward makes sense, but notice we're not getting aggressive with new money shorts here. We're not looking for the market to rotate down to 406.15. We're not looking for a break of the bottom of the balance range based on that trade. This is a trade. This is a scalp. This is taking the market day by day into the remainder of this week. It would not be my first choice, but if it's the trade that sets up, this I think is reasonable as long as you respect a tight stop over 410.35. And that's really it. That's what we have here on the SPY hourly time frame chart. There's not much more nuance to bring other than that. So let's move into some supporting evidence. Market internals are Exhibit A for supporting evidence. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. For the most part, we want to compare Tuesday and today's session, Wednesday. If most of the damage was done on the Tuesday session, that's where the bigger range expansion happened. Today was really more consolidation at the lows. You would think that the internals were more bearish on the Tuesday session, but clearly they were not. And this, again, is the issue with NVIDIA earnings potentially causing a gap green over red, right? So on Tuesday, very mild outflows from the market into the close here, hardly even getting, like nowhere near negative 300 million. It's basically at parity, the zero line. On today's session, it's the complete opposite story. Much more of our very classic bearish indications, big outflows, negative 300 million. Same thing, advanced decline line. Gets positive early in the session on Tuesday, fades into the close. Classic trend lower zone on today's session. New money sellers more active here. This is kind of like, okay, pullback, consolidation, not the end of the world just yet. Same thing with the cumulative tick. Remember that the cumulative tick will never lie. The tick will not lie. This, of course, is going to be depressed in trend lower zone as we get a big gap down and never make an attempt to close the gap, right? Same thing with outflow volume. Of course, most of the volume is going to be flowing into things that gap down, aka are underneath the previous day's close, so it's no surprise that these are red, but look at the cumulative tick. This tells us that there is sustained selling pressure throughout the duration of today's trading session, and if we gap green over that, any new money short who is now active and positioned poorly on these lows will likely squeeze out for tomorrow's session. So not only did we have the thin structure I was just showing you on the hourly time frame chart here, we have internals that support the idea that more short positions are held here instead of through this breakdown here, and thus a gap green over red could cause a squeeze to achieve 417.25. Exhibit B is always the market profile. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. A couple of really big takeaways here. Let's start off with the bearish takeaways. Bearish takeaway number one is that we had a double distribution on the Friday session of last week, and Monday, early on in the session, we clearly showed a rejection of that upper distribution here and accepted more so in the lower distribution, D2 we'll call that, which is a bearish indication. Now, things get interesting as we move into the Tuesday and Wednesday profiles, because just like we built the case for the short squeeze in the internal, we can see similar things happening here in the market profile. If today is the day where, based on the internals, we know more sellers were getting active, notice that the point of control did shift lower with price, the value area did shift lower with price. That means that a majority of volume was committed at these lower price points. So once again, if we gap green over red and most shorts are being held from a lower portion of today's range, it increases the odds of a squeeze unfolding in the upward direction because those shorts will be underwater. Now, we can add on to that if we consider what happened on Tuesday, with the point of control being left higher in the profile, not migrating lower with price. Value area was also higher in the profile. So from a volume commitment perspective, it's not like new money shorts were getting overly active as this market was moving lower. There was more activity here closer to the open, and thus, what should the target be? 417.25 on the SPY daily, SPY hourly, and from an ES perspective, the level I would give you is 4194.75. That is a VPOC, and once again, the fact of where this volume is being distributed here versus here builds the case for this short squeeze to potentially be a highly likely outcome if we gap green over red. Jumping back on over to the platform to evaluate the weekly performance of our sectors actually reveals that things aren't that bad from a posture perspective. I mean, leading the pack is energy. It's the only green name on the board from a weekly standpoint. Not great, but it would be the end of the world if XLB down 3.38% was replaced with the XLK, the tech sector, the heaviest weighted sector, right? XLB materials is fairly lightweight, as is real estate. Consumer staples is more D for defensive. Financials, not great to see them down about 2.6%, but notice that tech, discretionary, and communications, they're not the absolute laggards on the week. Again, Armageddon situation is when your XLK is falling off of a cliff and the market's also pulling back with it. So with that said, let's check in on the structural charts and just see what's going on here, because this will always be a little bit more informative. Of course, energy going sideways in this box, threatening a break here. It's not the end of the world as the market's pulling back. A little bit of rotation isn't going to hurt anything out of energy lightweight sector. This is a bit more concerning out of XLB materials, just noting that this breakdown is producing sharp new lower lows, and this has to do with obviously building new homes, and I suppose ties directly into real estate as well to some degree, right? Materials, home improvement, wealth effect comes to mind. So if people's wealth, perceived wealth, is going down from their home values, obviously it leads to lesser investment. So that, of course, is going to be a drag on the market. So I will concede that these big lower lows being produced is concerning, but they are lightweight sectors overall for the S&P itself. Let's take a look at consumer staples. This is a bigger issue, obviously falling off of a cliff here, not holding this consolidation. The main issue is that we were looking at these hammers as being somewhat suggestive of an opportunity for a move back into the range and seeing healthy rotation in the marketplace. Obviously falling off of a cliff here, it's not ideal. It's okay that it's a D for defensive sector, but hey, I mean, come on, downward pressure is still downward pressure for markets. Not great out of the XLP, perhaps catching ourselves for a footing at the daily 200 SMA, but really beyond this, you're looking at 73. 73 is the next major area of potential support out of the XLP, so watch that for the remainder of the week. XLF here, financials, also continuing to be a red flag for markets. We were looking good, trying to make that break and recapture of 32.25, obviously underneath on a massive gap down for today's session. Red flag, bearish drag for markets. XLF, I will say, is one of the heavier weight risk on sectors, so this isn't all that comforting. XLI is threatening the bottom end of the range, but it hasn't done it yet. Just like the XLB, just like the XLRE, it will become more of an issue if we start making big new pivot lows. Hasn't happened yet. Keeping an eye on that 96.75. XLV for the healthcare sector, again, more similar to the XLP for staples. We were looking for this and this kind of interaction to be like, okay, market can't really make up its mind in this general area. Let's see if it can go sideways and hang in there to keep the broad market afloat. The breakdown of these lows is the most concerning part. The breakdown of these lows, new lower low being produced, is the concern out of the XLV. Now again, these are D for defensive sectors that are falling off of a cliff, barring the XLF. I'll say that, barring the XLF. XLP is defensive, XLV is technically defensive, but again, downward pressure is downward pressure. This isn't great, but as we start looking at things like the XLK, this is where I can sort of think to myself, okay, I'm not crazy for saying not all hope is lost in the market, right? If you look at something like this, big break, retest, find support off of the breakout level at 150, 150, it's not totally unreasonable, right? The XLK has not deteriorated so far from a structural perspective where all the red flags should be going off. We should be alarmist. We should be looking for the market to go to zero. It's just not the case. And of course, with NVIDIA earnings in the pre-market or post-market now, it's 156.02 by 156.89. So I'm squinting my eyes at that tiny print, but it's somewhere in this general range. So right up towards these equal highs, not the end of the world if this is going to be your big weekly high or low in the XLK, right? It's hard to have a full-blown risk-off markets going to zero type attitude if this is the case. Same thing is going to hold true with the XLY. I mean, this one's much closer to its level here, but it did produce a hammer candle, long lower wick supporting at 148. In the post market, we're 148.68 by 49.85, so it's not completely resolved here, but we're staying above it. Hopefully, if the XLK can continue higher, it'll be enough of a ripple effect to sort of keep this afloat over the 148. I'm not trying to build the case that it must hold, but 148, just building the case that this level, nonetheless, is going to be your key watch. Now, over or under, that's up to the market to decide and for us to interpret, but 148 is still holding its merit, and as of right now, it is going to possibly act as a break and retest higher low. XLU for utilities, mildly lower. Mildly lower, not the end of the world. Remember also, this is D for defensive. If anything's falling off of the cliff, I would have preferred for it to be the XLU coming into these equal lows back here, but we don't get our way all of the time, so no red flags there. And then the XLC, again, think about the structure here. Break, retest. Is it certainly reasonable that we can find a higher low over 60? Absolutely. If the market does that and we get some sort of look like this, good to go. I mean, structurally speaking, everything is sound and intact here. The worst thing in the world would be a break and then lower high underneath that then turns this into a head and shoulders. If that happens, then absolutely, we will be more, reluctant to say bullish things about the market. But once again, I think the squeeze case is on the table. I think that the heavier weight sectors have not deteriorated so far to a degree where an outright bearish stance should be taken. Don't get me wrong, the market can break down, but I'm not seeing the evidence for a larger down move just yet. Here's the sector ratio grid. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. It's just a different way to visualize relative strength and weakness from our sectors. Notice that the top 4 heavyweight sectors for our market, at least where they count from a risk-on perspective, are hardly changed. Although the market's been pulling back aggressively, tech is still outperforming. So is that a risk-on indication? I would have to say yes. I mean, obviously the XLF continues to be the biggest issue for the risk-on look, but it's been that way. We know that it hasn't recovered from the banking crisis back here, and it actually did make a lower low on today's session. So this is the only issue with the risk-on look, because other than that, notice that the XLY just produced a higher low, trying to make it back up for that equal high. And I would imagine that this makes a new higher high tomorrow with the NVIDIA gap up, dragging the tech sector higher. And the XLC, the closest sort of risk on in terms of relationship sector, just made a higher high as well. So risk on is not fully phased out. It's just financials that are a big issue. We know that the XLV is up here because it's the second heaviest weighted sector, but it is D for defensive. So going sideways down here is not the end of the world. The bottom 4 sectors are undoubtedly the risk off sectors, and this relationship is, obviously bearish in the ratio, which means bullish in terms of risk off being truly turned off. Same thing with the XLU falling off of a cliff here. I mean, it's mildly sideways, but it's underneath a descending at this point 50 SMA. Energy is perking up. It's the one thing to keep an eye on, but it's still in an overall downtrend, and real estate wealth effect certainly moving lower as well. If we take a look at something like our XLY over XLP for, as we know, growth versus value here, growth is still outperforming. Notice that this has made the move in the upward direction, recaptured the 50 SMA, and it's just consolidating at these highs. So as the XLP falls off of a cliff structurally and ratio-wise, obviously this is helpful for more of the risk-on look. So as of right now, no evidence on the screens themselves for a huge breakdown based on S&P price action. As we move away from the S&P price action itself and into some intermarket relationships, it's worth pointing out and reminding ourselves that every data point we're about to look at is exactly that. One data point in the web of analysis that we spin before ultimately making a trading decision in the S&P. I would also remind you that the S&P price action itself will always reign supreme. So just because we see a number of bearish divergences is not an excuse to go out and blindly short the market if there is no price action setup to sort of confirm it. Is it a reason to be skeptical of upside and perhaps sit on your hands instead of try to play the upside? Absolutely. Absolutely. Those are two totally different things here. So the dollar is up first on the chopping block. Obviously, a move in the upward direction would be supportive of the bear case down here in equities, and this is being confirmed by the gold contract, putting in a bear flag underneath the $2,000 price point. So what I would watch for here is primarily a breakdown from the gold contract underneath these equal lows. The number is going to be at 159.20. A move underneath that would not be helpful for equities down below. I still think the short squeeze situation can unfold inside of this range, but if this breaks down, you're certainly not going to see more support from this relationship for a larger break in the upward direction in equities. And this should make sense as well. If we take a look at the TNX, the 10-year interest rate, this is breaking a range in the upward direction, in theory, supporting the move lower in gold, but also putting downward pressure on the XLK tech sector, the heaviest weight risk-on sector of them all. I wouldn't blame you if you're very cautious bullish about a move in the upward direction here out of our markets under this, under these circumstances. Here is the Fed tracker tool and decreased odds of a pause in the next meeting. That's going to be on June 14th, and increased odds of a 25 basis point rate hike. Now, mind you, the odds are still an overwhelming majority for a pause, but the concern here is if we look at the probabilities tab, remember that higher for longer wasn't the end of the world, but now that the debt ceiling crisis is potentially not going to be resolved and they are going to let it sort of expire, so to speak, an interest rate hike just in theory makes our debt more expensive to service. And I imagine that the projections get far worse than what analysts are already sort of anticipating if it's not resolved. One of the initial claims that I've seen is after a month of not resolving the debt ceiling, right, there's expected to be about a 7.8% unemployment rate from the 3.5 we got in the last reading. I don't know about you, but that is certainly not indicative of a bullish environment for equities. So this is a cause for concern. Whatever happens with the debt ceiling happens with the debt ceiling. We're going to have to react and adapt as traders and stay nimble. There's nothing we can really do to have a big impact on that as traders. But back on over to the platform, let's take a look at our risk appetite. We'll try to move through this a little bit quicker. I know the video is late tonight. Here's the TLT bonds, obviously continuing this downtrend on a relative strength perspective. So is the traditional flight to safety trade on the table? The answer is just simply no at this point. Now, one thing to bear in mind is that all of 2022, as the downdraft was taking place, bonds were also moving lower. That traditional flight to safety trade wasn't working. So could we fall back down into that where bonds and equities both fall? It's a possibility, but as of right now, investors are not flocking into the TLT as some sort of safe haven. So at face value, we'll take it as neutral from a risk on perspective. If we take a look at something like the HYG, you'll notice here that junk bonds continue to show us just divergence after divergence after divergence, right? So these equal lows were produced, and this, of course, produces a lower low, once again, supportive of the bearish case for equities. And if we take a look at the digital gold, we haven't done this in quite some time, but here is the Bitcoin chart on a daily time frame. Just notice that it is putting in a close underneath this prior higher low set, right? If some reversal was going to be underway, this sort of needed the break off of the higher low, considering that we already have highs, lower highs, right? So downtrend here still remains in effect, and that, of course, does not speak well to overall risk appetite. Not everything's fine and dandy, basically, from Bitcoin here. Let's take a look at some breadth. This, of course, continues to be an issue. The new highs versus lows on the week have gone negative after closing positive last Friday. If we take a look at the SPX A200R, big downdraft underneath the 50% mark on this week's trading session thus far. This is a big red flag for markets, but perhaps the largest red flag of them all is the SPX A50R. This is a daily time frame chart as the market has been pulling back. Notice that equities have not made a lower low. The SPX A50R has certainly made a big lower low. It never made, we talked about this on Saturday, right? It never made the equal high as we were breaking out. This perhaps is the biggest red flag for our breadth indications. If you're going to carry forward any bearish divergence, this is the one to put the most weight into because of its implications on the daily time frame chart and the failure for the S&Ps to really at least hold neutral in here as this pullback has unfolded. So this, of course, does stack up as more of a bearish data point, and the same thing can be said about the RSP. So this is equal weight S&P on top, making a new lower low in here, whereas our regular weighted is still inside of the balance range. So breadth remains horrible. There's no surprises about that. Let's take a look at some VIX here. Volatility is shooting in the upward direction. No surprise as markets come in. The big question is if tomorrow we get the short squeeze, this is likely going to back down off of 2050, and lo and behold, we just have the ceiling remaining intact. So keep that in mind. If we see the short squeeze, this is likely coming in, and that would make sense structurally out of the VIX itself. The VVIX, as we know, continues to show some issues with the break over 103. So volatility of volatility getting a bit, aggressive here in the upward direction. That certainly is not comfortable for trying to look for upward continuation out of markets themselves. And last but not least, we'll take a look at volatility futures here. And we are moving closer to a backwardation, but we're certainly not there yet. This is well underneath the zero mark, even 9 versus 30-day VIX here. So if you're skeptical of 30-day options being broken, everybody's all about zero DTEs. This is the closest read we can get on that. Notice that we do have still a read underneath the zero mark here. This is the VIX 1 day, and notice what happened on today's session. This is the largest read we've seen in quite some time. this will be interesting to carry forward. Once again, I don't think we have enough data to make any assumptions about this yet, but this is starting to become a little bit of an anomaly outside of this box. So keeping an eye on it. If anything, this just tells us that intraday, yeah, people were certainly nervous about upside on today's session. With that said, what would this tell you? If there are a lot of people who are hedging with puts, could there be a stronger squeeze in the upward direction tomorrow if we gap green over red? That's the key there. If we gap green over red, this may support that idea. So this is a potential use case for the one-day VIX as we move forward, sort of determining what the next day may have in store. The QQQ daily time frame chart is clearly different, nowhere even close to the midpoint of the original balance range. Coming off of the higher highs, still searching for a higher low is totally reasonable. Much more of an uptrend, clearly intact, and we've respected the lower edge of the weekly expected move, closed a green indecisive doji as opposed to a red bar. Much stronger chart here out of the QQQ. If we come in from the breakout candle low to the top of this move, this most recent leg up, the 38.2 Fibonacci retracement is right there at the lower edge of the weekly expected move. 330 is the number, just telling us that ideal picture-perfect bull flag consolidation remains in the zone, and based on today's daily bar closure, it's obviously much healthier than the S&P itself. If we take a look at some anchored VWAPs here, something I want to point out is if you bring in the anchored VWAP from the red bar low here, that's fine and dandy. You get confluence of support with 328.50, but if you bump it forward to the day when the breakout actually starts, just one day forward, 0505, there you go, confluence of support right near the lows of today's trading session. So are we cherry picking data? You can decide for yourself whether or not you want to use this or this, but overall, there's a number of pieces of confluence of support just underneath us towards these lows, much more indicative of the uptrend being healthy in the QQQ. If you take a look at the hourly time frame chart, a number of nuances here. As we know, the NVIDIA gap up is clearly propelling us higher. 336.60 is the current trade price, which is somewhere up here. So are the shorts going to get squeezed out of the Qs? The answer is more likely yes, right? It's very likely that this gap holds, whereas the S&P gap is like flirting right on the edge of possibly being a gap, maybe not, right? So the QQQ is more likely to open on that gap and sustain the gap into tomorrow's open. And most importantly, if it can stay up around 336, it's above the breakdown point from Tuesday. So as we know, sellers did get more aggressive. Here is the internals for the Qs, right? Or the NQ Nasdaq market. You can still see that the sellers were more aggressive on today's Wednesday session as opposed to the Tuesday session here. Here in the advanced decline line, cumulative tick speaks for itself, right? So if more sellers were getting active here, let's go back to the hourly, and we know that this was thin structure to retrace, but still, even if sellers were getting active in here, these folks will get squeezed, and anyone who was participating there, although it was less in terms of the net aggression from the internals, opening above puts all of those sellers in jeopardy, which is obviously more indicative of the short squeeze being possible than the S&P, which is trying to get a gap in the first place. So 335.50 out of your QQQ, key component. We just saw internals, and I'll show you the market profile here, a very nuanced indication. Everything still remains the same in terms of position of the point of control here versus here from the Tuesday session, but the nuance that we don't have out of the S&P that we do have in the Nasdaq is this right here. Notice that we closed the single prints out of the Nasdaq and we reverse, putting in a poor low. If stronger sellers were being active in this market, people with 6 or 9 month time horizons, core traders, positional traders, are they going to stop at a very visual reference point such as single prints? Or is this more indicative of short-term momentum traders not getting continuation underneath a structural element that's visible to short-term momentum traders, and then we see a reversal in the upward direction? I don't know about you, but to me, longer-term sellers are not really getting active here. So, as we can conclude, if shorter-term sellers were the ones pushing markets here and pushing markets here, short-term sellers, not that it's a good or bad thing, it's just the nature of the game, short-term sellers likely have weaker hands than long-term sellers. It's just a fact. So opening above these highs, once again, is much more supportive of the sort of squeeze in my estimation. IWM Russell 2000 and the small caps, the daily time frame chart speaks for itself with a sharp rejection off the top of the balance range here at 179, confluence of resistance with the band of anchored VWAPs from all of the major pivots after the October low. And most importantly, not only was it a gap and go, but this is not going to have any of the pick-me-up from NVIDIA earnings. So in the post-market, we're basically unchanged, 175.24 by 39 as of right now, which is underneath our key inflection point at 175.75. Just remember that we had consolidation. Bears will always get credit where credit is due. They were doing a great job keeping price underneath. This started to jeopardize that. Thus, 175.75 is still the line in the sand, as in if we get more acceptance underneath, you would have to imagine that this just turns into a rotation from the top of the range down here towards the bottom of the range at 171. If we take it one step further and look at something like the hourly time frame chart here, even let's say the market short squeezes tomorrow and NVIDIA sends the S&P and the Qs higher, if the IWM produces any lower high underneath 179 at this point, what pattern did I just draw in? And again, patterns aren't the end-all be-all. It's really the structure of high, lower high, equal low breakdown starts a new downtrend, and once again, the bottom of the daily range certainly comes into sights. That's going to be at 171. That would be more of a bearish red flag for broad markets, just remembering that this acts as a risk-on, risk-off proxy for the S&Ps and Qs. Apple is going to kick off the core list of companies on the 1-hour time frame chart. What we're looking at is a 100% retracement of the overall move, and we've already started to produce a lower high into the close of today's session with this little pullback starting, and currently no love from the NVIDIA earnings. We're trading 171 basically towards these lows in here. So an equal low breakdown ushers in a gap fill to start that's under 170.75, closes to 167. If the broad market is squeezing tomorrow, I would not look for this as a primary situation to trade. If the broad market fades aggressively because NVIDIA can't hold up on this big gap, this is on the table as a setup through the gap range here. Bulls only have something going on with a higher low over 172.65. Netflix is up next. Once again, these are hourly time frame charts we're looking at. Here's the breakdown point from the Tuesday session, right? Obviously today, constructive on a higher low here. So it's really hard to say what will happen until we resolve 364.75. We've closed literally right on the level, and this too isn't really being impacted by the NVIDIA earnings, so kind of flat right here. If we're above, constructive for the rotation back to the sort of momentum run highs, closer to 374.50. If we're underneath, I wouldn't look to get too active in here, and then the short is underneath the higher low at 359.75 to start to get down through some of this remaining thin structure in here. Think of it like a pie in the sky, inverted head and shoulders, if we're getting that acceptance over 364.75, right? Next up, let's take a look at Tesla. This one deserves going to the daily time frame chart just because of the candle structure here is so hideous. So inverted hammer to regular hammer, and currently a little bit of upside based on the NVIDIA gap, right? So we're kind of opening in between those two bars. You know, if you just smash the two together, you can sort of picture this as an indecisive doji, right? If you combine the two candles, that's what you get, and you're opening in the midpoint of that. So I'm not really thrilled with outcomes there. I suppose, if anything, on the daily chart, the reason I wanted to bring this up is because, sure, it's trying to find a higher low off the 50 SMA. It's trying to put in bull flag consolidation. I suppose opening over a hammer high is technically indicative of a long setup unfolding. But again, this upper wick is just kind of menacing on the daily time frame chart. If we go to the hourly, you can kind of see what I'm talking about, right? Big fake breakout here. This fake move to the downside. So more questions than answers in between these two ranges. Tesla is not a fan favorite, at least for me, into the remainder of the week with that current structure. Here's Google trying to find a higher low. The AI mania and the NVIDIA move higher is certainly helping, but we're only around 122.75 post-market, so I guess that's somewhere on a very mild gap up right now. But if we go to the hourly time frame structure, notice that your level is basically 122.15. If we're above that, I don't think the shorts have much to go on. If we're underneath it, then again, here's your double top neckline. Today was all consolidation underneath. That was a fantastic trade we talked about in the Discord. You know, staying underneath that, great, good to go. Look for the flush, and you're going to continue to rotate through thin structure. 117.50 is the target, but opening above, I have to imagine it's a similar setup to the short squeeze out of the QQQ itself, right? Gapping over all of these trapped shorts who are looking at this as, okay, constructive double top neckline breakdown, good to go. NVIDIA wipes all of that away. So kind of concerned, if we're on the short side at least, if we're opening over 122.15 in Google. Metaverse, what's going on with Zuckerberg's Fantasyland? Any love from the AI mania? Not really. Basically flat at 250 here in the post market. It is trying to stay inside of that 247.75 gap overhead. Here's the daily time frame chart. Don't even have enough range on it to show you where it's coming from, but the gap closes 289.60. You don't have to be the first one in the door. I'm going to continue to say that about Meta here. You don't have to be the first long, right? There's so much room to trade for overhead. Wait for a constructive new uptrend to develop. As of right now, technically on the hourly chart, we're in a downtrend with low lower highs and lower lows as well. Wait for this to reverse, wait for a higher high, wait for a higher low, and then we'll look to trade through that gap range. Until that happens, I'm neutral. If we do start breaking down underneath 241, that changes my tone. Let's take a look, at NVIDIA. Here it is. And of course, I mean, we've got to show you the gap. Look at this monster move. I mean, chart speaks for itself. I won't be touching this tomorrow morning. I don't think you should be either. Oftentimes, gaps of this magnitude just go sideways. You have everybody piling in who wants to go long from the upgrade. You have longs taking profit who are selling up here. You have new money shorts who are trying to sell it at a higher price. You have shorts down here who are buying because they're getting squeezed out of this thing. It's a big old cluster, you know what. I wouldn't touch it with a 10-foot pole. So wait for the dust to settle on NVIDIA. Next up is going to be Softy. Let's get rid of these extended hours. It's just too overbearing to look at. And zooming in here, again, what is the implication gapping up and over at 319? 319 is up here, up and over all of the bearish consolidation through a decent portion of the Tuesday breakdown as well. I'd be cautious about a squeeze in this, taking out sellers who were active on today's session. Line in the sand would just be, again, think about this constructively. If we can produce, say we gap up to 319 and it holds for tomorrow, a higher low pullback that closes the gap, that is constructive. I would look for a gap fill reversal if we start selling first, and then a reversal to, 316.50 is your number. Downside, if we get back in here, fine, so be it. I would wait patiently for the breakdown of 313.50 before looking for a stronger short indication. Last but not least, the mini beast. What's going on with Amazon? People always question why we call it the mini beast. Do you remember when Amazon was trading at $3,000 a share? Oh man, those were the days, right? But anyways, it used to be the beast, now it's the mini beast, and we've got 116.85 as our level. Now, in the pre-market, or at least post-market, we are gapping up with the nonsense from NVIDIA. So as long as we're above that, you can see this level is as clear, it's crystal clear, right? There's no other way to describe it. It's crystal clear. Opening above, there's no reason to be a short. You would be looking for rotations into these highs. If we do get underneath, the lower high underneath is the short entry with a stop just overhead because the level is so clear, right? Your risk reward is fantastic. So if we reject it, lower high underneath, stop here, enter here, target is down here, right? Risk reward makes sense in that trade. So that's the core list of companies. Let's dive into these trade ideas. No fancy sort of breaks or anything. Let's go KDP on the first one here. This is an hourly chart still on the hourly time frame chart. Notice that we have consolidation, nice flat tops, 32.10. 32.10 is the number. The target should be here where this lower high was produced at 32.42. Let me zoom in a little more on this. There we go. That's much better on the eyes. So that's the trading range that we're looking for in the upward direction. This is an extremely cheap stock. It is not something that I would recommend you try to trade with options. There's no delta to really move in here. You're going to have to take a ton of options. You may as well just trade the stock itself in that case on, a margin move or something like that. Regardless, that's the move we're looking for. It's not the most lucrative, but here's the daily time frame chart and why I like it, right? So notice, as the market's falling apart, it does not produce a lower low. It continues to produce hammer candles. If we take out the hammer highs, there's your retracement into 32.42. Let's take a look at the next one, PINS, Pinterest. What's going on with Pinterest? This has been a theme of the video. 100% retracement. So I would be looking for shorts here in Pinterest. It just seems we've come straight from the bottom right to the top, and we've got this big gap to close overhead. I think it's got to pull back before trying to make a move. Now, I might be projecting a little bit here because of all the green we're seeing on a 100% retracement, but we've also got the daily 200 SMA, and Pinterest, believe it or not, on Thinkorswim is ETB, easy to borrow. So once again, I would not really recommend trying to short this with options. I would just go short the stock, right? It's easy to borrow. Why not? Looking for a little bit of a pullback here off of 24.50 out of Pinterest. Let's go to the hourly chart together and try to find a target. I would look for this at 23.60. 23.60. So almost a dollar move in the downward direction out of Pinterest, available if we get that pullback in the first place. Last but not least is RBLX for Roblox, and this is just a setup to start keeping an eye on. You can probably see what I'm getting at here on the hourly time frame. Inverted head and shoulders, neckline is at 42 even. Here's the daily time frame chart. It's not really in play yet, but we did see a solid green bar on today's session. If we can breach it, there's gap to trade for overhead. And again, think about what we just talked about on Pinterest. This would be the 100% retracement. This is the pullback. Now we're looking for the break and a new set of higher highs to be produced. So this may take some time to unfold, but start putting it on a watch list, start keeping an eye on it. 42 is the number. That's going to wrap up today's episode of the Midweek Market Update. If you appreciate the video or learned anything new, let me know in the comments section or by giving the video a simple thumbs up. If you made it all the way to the end, let me know with the night owl keyword down below in the comment section. I know it's a late one tonight. We haven't done this in a while, but I appreciate you all tuning in. I will see you tomorrow morning live in the pre-market prep at 8:15. Remember, no stream on Friday. And with that said, I wish you a green trading week.